Welcome back to this Bloomberg Special Report. I'm Lisa Murphy.
And I'm Adam Johnson. We are reporting tonight from Bloomberg World Headquarters. That's where we are, right here.
The market has been cratering.
Well, I'll tell you, I'm stumbling because I'm looking at my screen and there's actually green on my screen. We haven't seen that for a while, Lisa. As I look at the old Bloomberg terminal right now, I see the Dow futures are up about 70 points, the S&P futures up 8.5, and the NASDAQ up 17 points. Now, as we know, futures are very volatile. They're very illiquid. So you could see lots of moves, both lower or perhaps higher. But nonetheless, there's been a lot of red that we're talking about, and we had to get it out there. There is a little
trading
green.
in Asia has opened, and it does look as if the market's down, but does look like it's a little bit higher than it was right at the open. But of course, anything can change and anything can happen, as we've seen. All right. Well, investor Barton Biggs says he's lost confidence in both the world's leaders and its central banks. Well, here's what he's told our Carol Masser earlier today on Street Smart.
We could be on the eve of the next financial crisis. We shouldn't be, because there are things that could be done to avert it, but they haven't been done, and there's no signs that the authorities are going to do them, and so we could be on the eve.
Well, after 2 days of pressing world leaders in New York to take coordinated steps to prevent global recession, President Barack Obama hit the road to make his case for fiscal actions going around the country in John Boehner's backyard. Hans Nichols joins us from Washington at the White House view of today's market turmoil. Hans.
Adam, as you said, the president was on the road, but White House aides were monitoring the market, and Treasury officials were in touch with market participants for real-time data. The view is that today's drop has two causes, one lasting and the other is more of a perverse reaction to Bernanke. But it's that lasting concern, the Eurozone crisis, and some officials are worried there that the situation in Europe will have to get worse to create the space for Angela Merkel to be in a position to use German taxpayer funds to bail out other countries. That's the concern. Now, the second cause of today from the White House, well, the Fed action. But it's actually something the White House welcomes, monetary stimulus, and eventually they hope that it might turn the economy around. But they have been bracing for the short-term pain for some time, the market losses, as everyone processes just how grim the Fed's macro outlook is. But it's really no surprise at the White House. Officials from the Fed and Bernanke and the White House, they share a lot of market data. And all through the summer, White House officials increasingly saw a gloomy picture. Slow jobs growth and weak aggregate demand. That's one of the reasons the president went so big on his stimulus package, the $447 billion that he made that push for in a certain bridge linking Ohio and Kentucky. Adam?
Oh, yeah, imagine that. Well, Hans, what are the prospects of any spending getting through Congress at this point?
When the president was in Ohio, I was down on the Hill today talking to Republican lawmakers. They clearly want to do something, but they said the president, as well as Secretary Geithner, aren't making it any easier for them to find a compromise. And Geithner saying that the political system is broken just didn't help.
And we have a political system that looks manifestly broken, and it makes people nervous about the future. That is within our capacity to fix, as it is to heal the damage caused by the crisis. We just got to keep at it, make sure we're doing things that are good for growth.
Now, that kind of rhetoric, Adam, Lisa, it may help the president with his base. It doesn't help him reach a compromise with Republicans. Now, another thing I heard on the Hill today, don't worry about a government shutdown. House Republicans will get a fix on this reauthorization bill. They said the adults will come into the room. Don't worry about a shutdown. That's not something to be concerned about. Lisa?
All right, Hans, the adults have to be in the general vicinity, however. Do appreciate you joining us tonight. Well, for more on this intersection of the markets, politics, and economics, let's bring in Bloomberg political analyst Matthew Dowd. He's a founding partner at Via Novo, and he's joining us now live from Austin, Texas. Matt, good to see you tonight. Let's talk about where the adults have gone in Washington, because it seems to me that they need to be the ones that actually stimulate the economy, not the Fed.
Well, that's the difficulty. I mean, the adults have left the room, and they've left it a long time ago, and now we're just seeing the repercussions of what happened. This summer, as you all know, what happened with S&P on the downgrade, they basically said Washington is dysfunctional, it's broken, and this is why we're doing this. Nothing's gotten fixed since that happened, so every day we go forward without Washington and the leadership on both sides of the aisle, not only the administration but Republicans in Congress, inability to fix the broken process is going to continue making it more and more difficult for the financial markets and businesses in this country to feel they have confidence that we know where we're going.
Matt, a number of Republicans this week actually pulled the Fed into sort of the political fray. What did you make of that? I mean, it seems like the wrong thing to do as it relates to the Federal Reserve.
Well, it is highly unusual to attack the Fed in this. The Fed has always been seen as a sort of sacrosanct institution, much like the Supreme Court in many ways. You don't attack it. It's sort of above and beyond politics. But what we've seen in this unusual move is a number of Republican candidates, and probably a candidate that will get the Republican nomination, which has never happened before, attack the Fed and attack it in a very direct way. I think on its own, it's not successful, but if they couple with it an overall message of the federal system is broken, Washington is broken, the federal government doesn't know what they're doing, and the Fed is part of that, then I think it's successful. But on its own, it's a highly unusual move, and on its own, I don't think it's effective, only coupled with a broader message.
Matt, it's Adam here. If we read between the lines and try to connect these dots, if you have one aspect of the government, in this case the Republicans, criticizing another, in this case the Fed, are we really undermining the government's very foundation?
Well, you know, I think it's another level of undermining the government's foundation. The last polls that I saw show trust in the federal government and trust in Washington, D.C. is at an all-time low. And now one of the last institutions, the Fed, that people had some respect for is getting attacked and getting politicized and getting attacked for being political by the Republicans. It's just another weight in the barrel of why people are becoming more and more anti-Washington, which then makes it harder for Washington to respond to the problems that we face in this country.
All right, Matt, we're going to leave it there for now, but we are going to see you back here later in the hour as well. We got to talk about the president's approval ratings and whether it has more to do with the market than the unemployment rate at the moment. We're going to have more on that in just a moment. Thanks so much, Matt. And while we're on the subject of politics, be sure to tune in next month when Bloomberg and the Washington Post host a Republican presidential debate. The October 11th debate will focus on the issues voters say they care about the most: jobs and the economy.
All right. Well, still ahead, Lisa, on our special report here, Crisis of Confidence. We'll be back in about 2 minutes. We're going to be talking to an analyst who says it's time to put your money back into stocks. He is predicting, get this, a 20% rally. What do you think of that?
We're ending up on an up note here on the show.
Fine.
There are plenty of stocks that may look cheap at the moment, but does that really mean that the broader market has bottomed out, or will there be a better entry point for investors? Well, picking the bottom and the top is exactly what our next guest is famous for. Tom DeMark is CEO and founder of Market Studies Incorporated. He's also been an advisor to George Soros, Leon Cooperman, and Steve Cohan of SAC Capital, just to name a few. And he says that he's not a market technician, but he's a market timer. Great to have you, Tom, here late this evening. Tell me this. Where do we go from here? There is a lot of money sitting on the sidelines. We've seen it taken out of the market, and sooner or later, people have to buy, right?
That's right. The market is in a position right now where we're probably going to go through a phase of a washout phase. And once that's over with, I think there'll be a vacuum and the market could travel quickly higher. We've been awaiting this time for a good 6 weeks.
Now, in August,
as the market has traded sideways.
There were a number of people saying that we were going to hit the bottom in August and we would hit a point of capitulation. That clearly has not happened, as we've seen today. How do you know when it will happen, and what's the key levels that you look at to figure that out?
We have two market timing models which really dictate where the market is anticipating tops and bottoms. Those two indicators have been created over the past 40 years and we've had pretty good success. The whole thesis of our approach is primarily buying into weakness and selling into strength. And we do believe that the trend is your friend, but we added a corollary to it, except when the trend is about to end. So just because of our background, primarily in the institutional area and with trading large sums of money, we try to anticipate tops and bottoms before they occur. So we await the time when the last seller, figuratively speaking, has sold and the market has an opportunity to bottom. And conversely, at a high, we wait for the last buyer to buy. And at that time, the market typically tops.
Well, Tom, I want to go to your first chart. You brought 3 charts for us tonight, and on the assumption of pictures worth 1,000 words, you call this absolute retracements. Just walk us through this chart. You got a bunch of numbers. Those are the various points. Just talk us through how we interpret this.
Well, in 2000, at the March 26 peak, the market closed at 1527.46. At that time, we had a convergence of a monthly, daily, and weekly 13s, we call them, which identify trend exhaustion. And we were able to, with some level of confidence, predict that the market would decline. And what we did was taking what nowadays are standard retracements, but at the time, 40 years ago, when we were probably the first to pioneer these retracements, we experimented with them, and we did share them with the trading community. Specifically, if one were to take what's called a Fibonacci retracement, the golden mean, and multiply 1527.46 times 61.8%, lo and behold, you would arrive at 944.75, which turned out to be precisely the September 21st, 2001 low. And if you were to take the next level, which is 50% of the March 26th high, you would arrive at 776.76, and that was the October 10th, 2002 low. So both levels were mathematically derived, and they at the same time coincided with our model for timing, which were the 13s. And then conversely, after the, yes?
Tom, I'm going to break in just for a moment because there was a lot of jargon in there that for many people hard to understand. But I want to get to one number that you bring up, which is 1,076 on the S&P 500. And I was hoping you could sort of relate that back to the chart we were just looking at and explain why 1076 on the S&P is so critical.
Well, like I said, we've used these factors, and we arrive at price projections, and then we await our timing model to kick in at the same time. If you were to take the May 2nd high, which is approximately 1370, and you were to multiply it, what we call one of the absolute retracement ratios, which is 78.2%, you would arrive at 1076.10. And coincidentally, that was the Globex low for the S&P futures. On August 9th, the low was 1076.10 as well. So we see that low being violated to the downside, and we see that occurring in a highly volatile day during the day session. And that's one method in which we predict the low, and in combination with the 13s, which we'll show you in the succeeding two charts.
And Tom, I'm sorry to interrupt. We do have to head into break, but I did want you to sort of make your final point, which is once we get to that 1076 level, you said there's going to be some more selling, but ultimately there could be, what, 20% upside before year end?
Yes, there could. See, we allow the model, the timing model, to dictate when the market tops or bottoms. We arrive at price projections, and those are secondary to the timing models. Once we penetrate 1076, the overall timing model should be telling us at that time that the market has, in fact, recorded the last seller selling and the market bottoming.
All right. Thank you so much, Tom. Do appreciate you joining us. Great insight there. We're going to be watching for the 1076 level pretty closely.
He is extremely widely followed. I talk to so many traders who worship the work that he does. He's very specific.
Right. Takes a long time to digest a lot of that information. Very smart guy, clearly. All right. Coming up next, more on the political and economic ramifications of this crisis of confidence. We're going to bring back our very own Mike McKee and Matthew Dowd. Let's get to some breaking news. South Korea's Kospi down more than 4% now. Now it is set for its lowest close in about a month. Now, trading there just started, less than an hour ago, so it's a little bit too early to tell. It's hard to tell, too, if this is catch up to what we saw today, or this is leading a new trend downwards in our markets when we wake up tomorrow morning.
Well, and what's curious, and the key point here is, as we look at our futures, the Dow futures are up 62 points. You actually heard me right, up 62, right? And the S&P up 760, which would suggest that what's happening in South Korea is a catch-up to what we did today. But, you know, anything can happen overnight, and these U.S. futures are very liquid. All right, well, we want to bring back Bloomberg's best as we look at the crisis of confidence in both our political and economic leaders. We are joined by Bloomberg contributing editor. Can I call you an editor, Bill Cohan?
Oh, I love when you call me an editor.
All right, well, a contributor or an editor, we're very glad you're here. And our own economics editor, Mike McKee. And down in Texas, we are joined by Matthew Dowd, political analyst. Matthew, thank you for staying with us. Let me start off with you, Mike. The 10-year closed today at 1.71%. Never been there before. that's the one place people are going. It's so ironic that we're having all the problems in Washington, and that's where they go.
Well, at this point, there doesn't seem to be another choice because everywhere else has got worse problems. But the interesting thing, I talked to a number of strategists today who think we might see this rebound back into stocks because how low can you go? How much more are you willing to pay for the kind of returns you get? When you step back and say, what really changed over the last 24 hours if we're not any worse off than we were? Now, interesting thing to watch over the next 24 hours is the IMF World Bank meetings. All the G20 leaders, finance ministers, central bank heads are there. And there's some talk that maybe they'll get together, issue some sort of joint statement. Maybe a long shot, but it did work back in 2009. Put a floor under confidence might be something we could use now.
I think that's a perfect jumping off point, though, for Matthew right now, because I think that the rhetoric is people are fed up with the rhetoric at this point. They actually want to see some action. And Matt, I mean, the president in particular facing a lot of pressure, not because of the data as it relates to the economy these days, but really because of what's happening in the markets.
Well, the interesting thing, back a few years, we did this study, and about 70% of likely voters have some stake in the market. And so when markets fluctuate, especially significantly, and we noticed this during the Bush administration, it seems to have a bigger effect on a president's popularity and his approval rating, more immediate effect than a rise or a fall in unemployment rate. Now, the unemployment rate is important, but fluctuations in the stock market seem to have a much more direct impact on those approval ratings than the unemployment rises and falls immediately.
And Bill Cohan, let me bring you back into this. You wrote the book on Goldman Sachs quite literally. Goldman Sachs down 25, 30% year to date. How do you quantify what to do as an investor in a stock like that is arguably the Rolls Royce of its sector, and yet it just keeps getting hit every day? There's just no confidence in it.
Well, let's make sure we put this in perspective, Adam. At the depths of the 2008 crisis, Goldman was trading in the high 40s. So it's about twice as high as it was then. It's, down, it was close to 250 at its all-time peak as a public company. So, these stocks, fluctuate quite a bit, as we have learned. I mean, again, the thing that I, have come to learn about Wall Street stocks generally is that they don't really exist for investors. I think Wall Street firms exist for the people who work there because they take between 40 and 50 or 60% of every dollar of revenue that comes into those firms out in the form of compensation. What a great gig it is for the people who work there. And I don't blame them for trying to do it, but that doesn't make it a great place to be if you're an investor. And I think we're seeing the downside of that now. When business starts to fall off, these things get hammered.
All right.
They sure do.
Unfortunately, we got to leave it there. Thank you so much, Bill Cohan, Bloomberg contributing editor, also economics editor Mike McKee joining us here, and Matthew Dowd. Thank you so much for joining us live from Texas. All right, stay right there because we do have some final thoughts coming up right after this quick break. Tune into Bloomberg tomorrow at 2 p.m. Eastern. That's when our Sarah Eisen will bring you an exclusive interview with Olli Rehn, the EU's Commissioner for Economic and Monetary Affairs. Well, that's tomorrow, 2 p.m. right here on Bloomberg.
And you want to